Hi everybody, my name is Adam Meyer. I'm back with another video, and today Jerome Powell, which is the head of the Federal Reserve, they spoke on the inflation, the GDP, and everything. So I'm going to go over that. I'm going to go over what it means for the economy, what does it mean for stocks, and what does it mean for crypto, and how we can make money, and also prepare for what is about to happen. So let's get into this here. So over here on my Discord, this is where I dropped a link over for YouTube to listen to Jerome Powell, which is the Fed chairman, speak about inflation, GDP, and also how they're going to battle inflation, how this war is happening and how it's affecting the economy, and also what we can expect within the timeline of things to play out with either just the overall market in general. But right before Powell started to speak, there was a report that came out that gave the projection for GDP. And we're expected to see a growth of 2.8% within 2022. 2023 is 2.2%, and also 2024 is about 2%. Whereas a lot of people took this as a really bad thing because last year was 5.7%. But the reason being is that last year we were just coming out of the pandemic and we were just growing at a rapid pace. Unemployment was starting to come down finally, and the economy was just booming. The economy is still booming, but we're not expected to see as high of a growth because we saw a lot of it last year. So this was kind of like a red flag for the market. And if we go over and look at the stock market itself, the overall NASDAQ market, which is right here, when that news first came out, the market just started to tank. Right here around 2 o'clock, it started to just tank based on what the GDP growth numbers are. So when Jerome Powell started to actually speak about the economy, it started to move up higher here. So inflation was 7.9%, but it was expected to be about 2%. So that's actually bad. But due to supply chain issues with COVID, that's why the inflation is starting to come up and like show up now because of the supply chain. There was so much demand, but the supply chain couldn't handle it. So stuff couldn't get to stores, it couldn't get out, and people couldn't buy what they wanted. There's only limited supply of certain things. Certain things couldn't be manufactured, and delays and all this and all that. So that's increasing supply. So that's supply and demand. And what he's doing, and which was the good news that he was talking about, is that when they increase interest rates, it'll slow down the demand for goods. So it'll slow down the demand for cars, phones, computers, just certain things throughout the entire world that everybody buys. So as the demand slows down, it'll then be able to match up with the supply. So the supply and demand will level out, which will then level out inflation to be closer to 2%. That's what they're saying now, and he's very confident that this is going to happen over the course of the next year or so. So with inflation being so high, he's also saying old inflation was based on supply chain, but new inflation is based on this war with Russia and Ukraine. And it's affecting a lot of energy, as we all know, gas prices. If you go out and look at gas prices, I'm not really complaining too much, but I know a lot of other people are, but I'm just living with it. I'm not really complaining, but if we see these gas prices, so that's going to increase inflation a lot in the energy sector. And also gasoline and oil, all types of oil going to go up based on these inflation. So that's looking to push this back 4 months. So the peak of inflation, let me draw this out for you actually on a chart. So peak of inflation was expected to be here in March. As of right now, and then come down and like level out and then taper down towards like the end of the year or like in the summertime. But we're actually seeing it still rise, and we might see it rise until like June, July, August, or September, all the way up into here. That's when we're going to see the peak, and then we're going to start to see it like level out. And then after we start to see it level out, that's when we're going to start to see it come down, just the rate of inflation. So right now, let's say it's at 8%, and it's going to go up to like 9%. Maybe even up closer to 10%, which is crazy, and then level out and stay around, I don't know, 8, 9, 10% for a little while, and then start to taper down into 7, 6, 5, 4, 3, 2% inflation per year. But this might be closer to the beginning of next year. So that was a key takeaway that I got from this. So like I was saying, the supply and demand issue, so the rates will go up, which will be looking to reduce the inflation and then lower it over time. So then supply and demand is better, and then they stop with the rate hikes. They start the money printer up like crazy again, buying back all these other assets and whatnot, and the economy will start to boom again. So what does this mean for the market? Let's go over into this chart here that I found in one of the group chats I'm in. I'm not the one that created this, so I'm not taking any credit for it, but it was somewhere on TradingView that I saw. But you can see where the Federal Reserve raises their hikes, their rate hikes before. The market comes down. It's a 16% drop. That's where they warn about the rate hikes, actually, right here, and then this is their first hike. So it goes down with the warning, comes back up, and then it comes back down. So we just had our first rate hike. If we look here at the overall NASDAQ market, we just had our first rate hike, and we're not really seeing a sell-off like right now. This was the warning up in here, and then it started to fall down due to fear, and then we had the war, and then now we had the war and the fear of the rate hikes. But I feel like the rate hikes and the war are already priced in, so that's another key takeaway. So priced into the rate hikes, so the fear of it, and also the war is already priced in. So now we know things are here. Unless things get really, really a lot worse with the war with other countries, I expect the market to actually slowly work its way higher for now. And then if we get some more bad news on inflation, it's not doing the right thing, we might actually see the market come up into here and then finally just tank off. And then this will be the next big buying opportunity for investors. For me personally, I am buying down within here and slowly adding my portfolio. All right, I'm gonna go back over into this chart here, and we can tell when they raise their rates, we do have to actually be cautious because sometimes it'll go up. So if Fed raises rates for the second time, it actually goes up. But we just got our first raise for the first hike. So this is where it went back down. This was back in 2015, 2016 area. But over here in 2018, here's where they did more hikes and it went down. And then their ninth rate hike, it also, it was down at the bottom. So then it started to come back up and it had a rally, as you can tell by this. So if you want to pause the video and actually read these and correlate it to what we can see with the new information we have in our chart now, you can. But it's kind of uncertain about what's actually going to happen with the market. I think we're going to see a move higher and possibly a retracement or even a lower low compared to like what we have now. And then we're going to actually see buying up, or we're just going to consistently go up at a small rate. So we don't really know. All we can do as investors is dollar cost average and just predict for a better future 5-10 years down the road or something like that. But I do want to go over into the NASDAQ chart to actually show you something that's very interesting to me. Back in 2008, I don't think it's going to get this bad, but this is something that caught my eye. But we did see in 2008, we made a high up in here. So as you can tell on the bottom, we're in 2008. We made a high, and then we pulled back, and then we made a new low. So we started making higher highs, higher lows, higher high, higher low, lower high, and then a lower low. And then we came up and made another lower high, and then a low, another lower high, and then a big lower low. So if you look just back on the time frame of this, so we made this low here around March of 2008, and then we came up like 19%. So this was after a 25% drop. So keep that in mind, a 25% drop, and then a 23% rally up. And then we had, from this rally up, we had a 50% drop from there. So let's go into the chart now. What if we just saw a sell-off from here of like 20%, 22, 23% drop, and then what if we see a move higher of like 20% back up into this range up within here, and then from here we start to see a drop and we actually get really bad news in the economy, something really just like hits the fan and like it just goes to shit. We could see a movement lower back down into here and down within this range. And this is the real buying area for long-term investors, the big banks, the bankers. So right now we could be seeing, oh, we got good news and the market is going to start rallying up, and this is where the banks are going to start taking profit. They're going to start taking their money and they might start reversing this market. But if we do have good outlook towards the future, we could just consistently start growing over time if the Fed doesn't completely pull the rug under us and completely shit the market. So that's just to keep an eye on. Nobody knows. So do your own research and invest at your own risk. So there we go. So if we go over here to the CNBC, we can go over to another headline based on what he just talked about. It shows a federal funds effective rate of just like their interest. And as we can tell, this is back in the 80s where interest was way up, like 19, 20% almost. And it started to work its way down, and now we're back over here in today. It was about 0% all the way down here. And this is back in 2018, 2019, they started to raise the hikes, and then they started to bring them down and then just print a ton of money. And that's part of the reason why the market's like been booming like crazy. And now you can tell they just started to raise their rate hikes. It's at 0.25% over here in March, and we're expected to come up possibly by the end of the year. We're looking to be about like right here. So if we draw this over, we're expected to be like up here by the end of the year. So what do these rate hikes even mean? It's where they charge interest to the central banks that then lend us. So mortgage, car loans, they're all going to go higher. All type of loans are going to go higher. Even credit cards are going to go higher. So more money is going to start costing more to have, well, to then borrow money. So borrowing money will cost more than it did when it was at 0% interest from the Federal Reserve. So that's what you got to keep in mind with this. So to wrap this all up, we can have some confidence here in the economy based on what Jerome Powell is saying. He's got a good laid out plan. He's got a good plan and a timeline of what we just see here with their interest rates. I personally think a lot of the fears are already factored into the markets. This also includes Bitcoin and other cryptocurrencies, but they all revolve in like their own cycle, but there's mass adoption. So if you're here for crypto, you can revolve this around crypto, but be smart in your own investments, because I'm not a financial advisor. So do your own research and everything. But we can have some more certainty now. We have more clear direction. There is still a lot of uncertainty with the war that could affect things. So don't put money in that you can't risk to lose. Still, personally, like I still have cash on the side, so I'm going to be okay no matter what. But be safe with your investments. But it's always good to dollar cost average for the long term, because you're looking for 5, 10, 20 years down the road for when you actually need your investment money. So this is it. I wrapped it all up here. Let me know if you have any questions, and take care, everybody.